So I recently made a video on my top 3 high dividend stocks, and you guys really enjoyed the video, so thanks for that. I appreciate it. But I want to follow it up with my top 3 high dividend ETFs, and I think this is going to be a very useful video. So the structure is going to be as following. I'm going to introduce all 3 of these ETFs one at a time, and then I'm going to give my thesis on why you should invest in these ETFs because they're all a slightly different means to a similar end. And then at the end of the video, I want to compare them all head to head and just see what that kind of looks like. Call me basic, but the first one has to be Schd. This is kind of the baseline dividend ETF. It's the best one. It competes with other names like VYM. This is a very similar ETF, but Schd is the best of its class. In the past year, it's gone up 42%, and in the past 5 years, it's up 78%. Very good performance, although something I want to note is just the past year and a half has been really good for Schd. So don't expect this to kind of continue. It's already kind of flattening out a little bit. But with that said, still a great ETF. The dividend yield is 2.88%, and even though it doesn't say it, this is kind of a dividend growth ETF. So if we look at that dividend data, we can see that it's growing the dividend very fast. This is a great ETF. As mentioned, this is a very basic equity ETF, very low expenses. The expense ratio is 0.06%, and that's because it follows an index, but this is the investment objective. So the fund's goal is to track as closely as possible before fees and expenses the total return of the Dow Jones US Dividend 100 Index. Some of the notable highlights are that the index focuses on quality and sustainability of the dividends, which is great, and it invests in stocks selected for fundamental strength relative to their peers based on financial ratios. I am a huge fan of the top 15-ish holdings. We have names like Pepsi, Merck & Co., Home Depot, Broadcom, BlackRock, Texas Instruments. These are all just quality names. The only thing I personally don't like, if I had to nitpick, is down here. It kind of has a long tail of names that I just do not know, like MTB, M plus T Bank Corp. I have no idea what that company is, and that could just be my ignorance, and that doesn't mean it's a bad investment, but you are putting money into all of these companies, so it might be something you want to look into. If we come over to ETF.com and compare the total return of Schd to the market, the S&P 500, we can see Schd has been doing great. If we zoom out to 5 years, the story is the same. It almost keeps track with the S&P 500 while having double the dividend yield. All right, now moving on to more specialized and spicy ETFs, we have Divo. This is an enhanced dividend income ETF, and the dividend yield is 4.72%. In the past year, it's gone up 31%. This is the fact sheet of Divo, and let's see what they have to say about it. So, 2 potential income streams. Divo seeks income from dividend-paying stocks and by opportunistically writing covered calls on those stocks. So it's pretty similar to Schd by having traditional large-cap dividend companies in it, but it takes it one step further with having opportunistic covered calls on top of it. Here's a breakdown of the methodology behind Divo. So Divo is managed with a strong emphasis on owning high-quality, large-cap companies with historical dividend and growth earnings. It's also pretty diversified across all the sectors, okay. Divo consists of 20 to 25 stocks, so it's not super broad, which to me, my opinion, I kind of like that. 20 and 25 is still very diversified, but if I continue, it says, which are screened and adjusted according to attributes including market cap, management track record, cash flow, and return on equity. I like all of those things. And the last thing is the covered call writing. So covered call options are written on individual stocks on a tactical basis. So that's great. It has dividend companies as well as tactical covered call writing on top of it to generate premium income. The thing is, I want to get a better understanding of exactly what is going on under the hood. And to do that, I went through this document so you don't have to. So this first section we already read, it's the basics of it. But down here, so the portfolio consists primarily of dividend-paying stocks that deliver cash flows from dividend and option income while offering potential for capital appreciation. So it's kind of a hybrid ETF. It has dividend companies and some covered call writing aspects of it. Now this last bit is more on the covered call writing process. So CWP seeks to lower risk and enhance total return by tactically selling short-term call options on some or all of the equity securities in the portfolio. The or all bit was a little bit shocking to me, but I think they do that just for legal reasons to protect themselves, because most of the time they do not write covered calls on 100% of the index. But I suppose they have the right to do so if there's a good opportunity. Specifically, CWP seeks to provide gross income of approximately 2 to 3% from dividend income and 2 to 4% from option premium, plus the potential for capital appreciation. Unlike a systematic covered call program like QILD, CWP is not obligated to continuously cover each individual equity position. When one of the underlying stocks demonstrates strength or an increase in implied volatility, CWP identifies that opportunity and sells call options tactically rather than keeping all positions covered and limiting potential upside. So that's what they mean by having opportunistic covered call writing on some of the assets. So that's what they're doing, but this is the results. So once again, we're looking at the total return of Divo. It's done very well this year. We always have to benchmark it against the market just to put it into context, just like we did before. And we can see that it is in this year trailing the S&P by a little tiny bit. If we zoom out to 3 years, we can see that most of the time it's pretty in line with the general market, but this little gap is the price you pay to have a dividend yield of almost 5% and less volatility. Now, the third and final dividend income ETF that I love is Jepi. It also happens to be the most complicated ETF. We can see it has a dividend yield of 7.5%, very high, and a total return in the past year of 28.5%. And much like Divo, a large portion of this ETF is large cap dividend paying stocks, but it does have options on top of it, and they do it in a bit of a different way using ELNs, which I'm going to talk more about right now. So first, the basics. It's designed to provide current income while maintaining the prospects for capital appreciation, much like Divo. The approach generates income through a combination of selling options and investing in large cap stocks, seeking to deliver a monthly income stream from associated option premiums and stock dividends. Once again, that's just like Divo. And lastly, it seeks to deliver a significant portion of the returns associated with the S&P 500 index with less volatility in addition to monthly income. But just like before, to really understand what's happening with this ETF, we have to look into these scary, intimidating documents. So the document begins by talking about what we just read, its objective, and then it says the fund does this by creating a portfolio of equity securities with a lower volatility level than the S&P 500 index and investing in ELNs. In implementing the fund strategy, the fund invests significantly in the equity securities of companies included in the S&P 500 index. So this ETF wants to be compared and benchmarked against the S&P 500, at least over the long term. Now, big disclaimer, this ETF is only a little bit over a year old, so it doesn't have an extensive history, unfortunately. But in order to generate income, the fund may invest up to 20% of its net assets in ELNs. ELNs are structured as notes that are issued by counterparties including banks, broker-dealers, or their affiliates. ELNs in which the fund invests are derivative instruments that are specifically designed to combine the economic characteristics of the S&P 500 index and written call options in a single note form. The ELNs provide recurring cash flow to the fund based on premiums from call options. The ELNs write and are an important source of the fund's returns. The ELNs will be included as equity securities for the purpose of calculating the 80% policy. Investing in ELNs may reduce the fund's volatility because the income from ELNs would reduce potential losses incurred by the fund's equity portfolio. So really quick, what that means, if the portfolio goes down a lot, you're still going to have some return in income from the ELNs, which can offset that downside fall. And then lastly, however, because of the call options written within the ELNs, the investment would also reduce the fund's ability to fully profit from a potential increase in the value of its equity portfolio. So that's just how call options operate. They do limit your upside because if it hits the strike price, the underlying equities get called away in the call option. That's kind of how they operate. But luckily, just like with Divo, this is a hybrid ETF, so it doesn't just systematically write covered calls on 100% of the underlying assets like QILD does. And if we want to look at the results of all this and compare it against SPY once again, we can see how it shakes out. It's very close to SPY. It does fall behind it slightly. And unfortunately, like I said before, we can't really zoom out that far because it's not that old of an ETF. But so far, it's doing a really good job of having competitive returns with the total market, less volatility, and driving that cash flow of 7.5%. Now, as promised previously, I want to compare all the ETFs together and see how that kind of looks. Okay, so blue is Jepi, Schd is in green, and Divo is in yellow. We can see over the past year, Divo and Jepi have performed strikingly similar to one another. And that makes sense. They're both hybrid ETFs. They have a lot of equity holdings within them, dividend large cap companies, with some covered call writing on top of it, although they go about it in two completely separate ways, and the dividend yields are quite different. And Schd, of course, is 100% equities, has the lowest dividend yield because of it, but it doesn't have any upper cap that covered calls introduce. If we zoom out a little bit to 5 years, once again, Jepi doesn't go back that far, but Divo does. And for most of its history, Schd and Divo have been completely in line with each other, and only recently in November of 2020 have they diverged a little bit. Now, I do want to reiterate, as I warned in the beginning of this episode, Schd has performed amazing since November, like way better than it probably should have in normal conditions. So keep that in mind, and we are beginning to see a flattening of its amazing performance, and the other ETFs are continuing to go up at a pretty steady pace. If we want, we can also add in VYM. This is just like Schd, but it hasn't performed quite as amazing in the past few months, so it might give a more realistic example of how Schd might perform in the future. And here we can see Divo has been doing better than VYM, and if we zoom in more so we can get Jepi back into the equation, it's much closer. So these are my top 3 favorite high dividend ETFs. We have Schd, pure equities. It's simple. Most people should probably go with that. It has unlimited upside potential because there's no covered calls, but it does have a relatively low dividend yield. And Divo and Jepi are pretty similar in the fact that they're hybrids, so they have lots of large cap, quality blue chip dividend companies within them, but they also have some kind of proprietary covered call writing process on top of that. Divo focuses on opportunistic covered call writing, and Jepi is more complicated. They use ELNs, they try to wrap them up into that financial derivative, and they get an interest rate off of that, as well as just basic covered calls. So more complicated, but we can see the results right here. And I think these are just some of the best high dividend ETFs on the market today. So that's the end of the video. Hope you guys enjoyed. And if you're still watching, please give the video a like. It helps out the channel a lot. Subscribe if you aren't. And I will see you in the next one.